So just ask yourself, maybe this time, when we also actually have the largest market capitalization to GDP we have ever seen, do we think with the slowing economy and the consumer being underwater as they are, and we start to see delinquency rates also moving up quite strongly, do we think that the NASDAQ is telling the truth, or do we think that maybe NASDAQ is becoming a little exuberant here, or a little frothy? I go with the last.
Henrik Zeberg, head macroeconomist at SwissBlock, and also author of the new book, The Monetary House of Cards, The Bust of the Everything Bubble Caused by Central Bank Hubris. It is so wonderful to welcome you back to the show. We are thrilled to have you as always, Henrik. Really appreciate you taking the time.
It's me who says thank you. Thank you for having me on again.
Well, wonderful. And I got to tell you, I've had a lot of requests to have you back on and more regularly. So I'm really excited to share with the audience that Henrik is going to be joining us every quarter from now on. So we're just thrilled to have his expertise. And gosh, Henrik, you and I were just chatting. I was reading your new book yesterday. I'm not finished yet, but I've spent several hours digging into it. And a lot of that framework that you're talking about, I feel like it's starting to play out now. So maybe for folks who aren't as familiar with your work, let's kind of start with the big picture, that macro view, the framework that you use to look at the world and where you see things headed. And one of the things about this program, Henrik, you can take all the time you need to set the table when it comes to that big picture, more of that macro
Sounds
view.
Good. Excellent. Well, so we all like to look at markets, obviously. We all like to put our money into to invest our money and then see a good return. But it's really about where the macro is going. And I think there are long time frames where macro doesn't matter. And then there are the moments where it's the only thing that matters. And I think we're getting to a point where it's the only thing that matters very soon. For a long time within the cycle, and this is back to my framework, when you look at the large picture, you have business cycles. And there are a lot of people out there trying to do and have their own analysis of how to look at the business cycles. We know there is a cyclicality to things, and we have, of course, central banks and administrations that will try to interfere with that. But in the general picture, you have these ups and downs in the economy. And basically, what you can look at is, say, on a long time frame, you have a long-term growth rate. But what you always will have is that sometimes the economy is growing more than the average long-term growth rate and increasing. And sometimes it'll then be, topping out there and then starting to still grow above it, but then start to decrease, but still be above the long-term growth rate. Later, you'll see that it crosses over that line and say, now we no longer grow as fast as the long-term. And then we have the wave 3, and then we have wave 4 when it again starts to come up again. Wave 3, or not wave 3, the phase 3 is where we see the recession setting in. And what we have seen now is that, and this is back to the framework or to my Zeberg business model, is that the economy is slowing down. Like what we have seen, we saw it into 2007, into 2001, and also in previous times. This model has never been wrong. So on a quarterly basis, when it has generated on the leading indicators a signal, it has never been wrong. It's like Titanic hitting the iceberg, it's going to sink. It may be that everybody thinks, oh, nothing is happening. I don't want to put on my life jacket, or I don't want to go to the lifeboat, and I'd rather go and have another, drink at the bar and hear the music play. And it may well be that for the next hour on the boat there on Titanic, that's correct, and that is what the model gives us. Actually, that in November 2006 we had the crossover of the leading indicators in my model, but it took a year before the coincident indicator, which is the one that really tells us now is the time. And it actually crossed in November of 2007, so just a month earlier than the recession set in. And we are now there where we have the leading indicator has crossed over already in November of 2024, which is also why I've said that for a long time I could see the deterioration on this. But the break of that came in November last year. But I also knew that it would take time. That's why I kept saying, blow off top. There's going to be a drink at the bar and another, dance maybe with the music, and everybody will think that this is a nothing. But it actually is. And the problem that people think that the economy kind of reacts immediately to tariffs and to whatever it is. It's not like that. We know it from you and I, ourselves, that even when now Powell comes out and adjusted rates and cut by 25 basis points. It's not like you and I go out the next morning and say, hey, you know what? We are going to save this much. Hence, we're going to go and spend that money today. That's not how the real economy works. It may work a few months down the road when we can look at our mortgage payments and rent and then say, oh, actually it looks like I've saved some money. Maybe I could spend a little extra. But that's with a lag. So the thing is that people have thought that we have had this, the bad things is already over. It's actually the bad things that we have seen so far has been the beginning of what is going to be the next phase, which is going to be an outright recession. It's not right here, right now. And there are things that needs to be we need to see in terms of with my model also. The credit spreads are not rising at this point. That's one of the things that's telling me there's no stress in the financial system at this point. We still don't see the spike of the yield spreads at this point either. Another thing, and we don't see it in the labor market really on the initial claims, which we should also start to see spiking up. We don't see that. Hence, we still have time. And these are the ones that I call the imminent recession indicators. They tell us that we have a structural problem, which is the housing market in the US. It's the consumer that is deeply underwater. And you live there, so you probably know better than I do. But I just studied the numbers. And you can see how deeply underwater the consumer is. And that is the problem. And then you have the whole financial world who say, oh, no, forget about that, Henrik, because you got AI and you got crypto and you got stable coins and you come up with all these things. And it's like, oh my God, we have heard this before, right? We've seen this before. We've seen how it really, where people are starting to talk about everything else than the problem at hand, and that is the slowing of the economy, which we saw in 2001 and in 2007, where it was just as obvious as it is today. I did not have that framework back then. Let me just put that up. But today I have, and it's actually showing it quite clearly. So in the biggest scheme of things, we have seen a crossover of the leading indicators, meaning that has been telling us for quite some time. Titanic hit the iceberg. It's going to sink. Doesn't mean it does it immediately. We're starting to see some of those things. We just had the ADP numbers coming out today, minus 32,000. Not a great number either. Let's see if we get the numbers on Friday with the shutdown of the US administration. But we should see a deterioration in the job number, which my model, by the way, said already from November of last year, saying going into 25, we should see that. And I was pulling my hair out when we saw those numbers in May and June and so on. They were 144, 270. I think so. The first revision, the first number was in one of the months, and then we saw the revision in August, which really just lays it up like the model is telling us. So real economy slowing, and this is completely disconnected from what the market says and the S&P and NASDAQ and everybody in the financial markets are looking at right now.
Mm-hmm. Just to recap, the 4 phases from the Zeberg Business Cycle model. Phase 1 was the early expansion. I love the metaphor of like smooth sailing. Phase 2, late expansion, hitting the iceberg. The warning signs emerge. Phase 3 is the recession. The ship sinks. Phase 4 is the recovery, rescue, and rebirth. Are we now? I take it we're phase 2 because we haven't seen the recession yet. We hit the iceberg, and it took a while for the Titanic to sink. So, like you said, you can go get a drink at the bar, hence markets going up, the disconnect. I do want to talk about the markets and the disconnect, and let's explore that a bit more because, oftentimes, we'll have folks come on and kind of caution and warn on the economy, and then see people in the comment section will say like, look at the markets. And it doesn't mean that you're not in the markets. Like you just know, like you're like, let's kind of get your bigger picture take on the markets and that disconnect.
But the thing is, people thinks in error that the markets are actually leading. It's not. It's incorrect. And again, people just need to go study. If you sit down and you take a look at the number of unemployed people, you'll see that every time it bottoms out before the stock market actually tops out. So you have in the model actually, which is what is it? And first of all, back to your question on whether we are in phase 2, the model actually has the leading indicators are already in phase 3. So telling us we are going to get a recession, phase 2, but the real economy, what we feel on a daily basis is still in phase phase 2, which means that we have hit the iceberg, but we're not sinking. And hang on here, I just got a call. And so then we'll see when phase 3 sets in. But at this point here, there is this disconnect into the market. And of course I am in the market. Of course I see that. But again, looking into history also and looking at what it looks like when you see the economy topping out in 2001 and also in 2007 and even in 2019, 18 and 19, we also had a slowdown. COVID didn't bring out the recession, which is maybe a little difficult for some people to swallow, but it was actually a slowdown, but it was ongoing already. And you can just look at the short-term yields back then and else, but also my business cycle picked that up. So we are at the point where it's getting, the real economy is rolling over, but we also know that's the time where the financial, the central banks of the world starts to cut. And if you look at it, they are actually cutting now. If you look outside of the US, like there is a very big thing coming. I mean, we have a lot of cuts around the world already, and it's only the Fed that is very far behind, actually. So it's not just about the US here, but people looking just at the market and thinking everybody is discounted in there. They actually will be late, and that's why again and again and again, people will surpass the point where we actually have seen the top, because they think kind of, they also adopt the understanding that, well, things have been going so great. How could they be so great in the markets if things were about to roll over? And that's the big disconnect. That's where the business cycle will actually help you more than just looking to the markets.
Mm-hmm. You just pointed out too, like even leading up to the 2020 pandemic, by late 2019, that the Zeberg Business Cycle model was saying that that late 2010s expansion was on borrowed time, recession was ahead. Of course, we saw no one really saw the pandemic coming, but just makes me curious, like when you see the central banks intervene, like how much does that impact, or how much does Fed policy impact like the various, booms and bust cycles? And it seems like we're almost becoming we have become, not becoming, we're so dependent on, central banks coming to the rescue, if you will.
Yeah, but we think that they come to a rescue. And again, first of all, they can never really counter it. They have never done it successfully. When we have had a crossover in the business cycle model, and famously back in the mid-90s, we actually had what people think, this was actually a soft landing. Actually, there was no crisis coming. The Fed started to cut, correct, but there was no issues there with the business cycle. There was not like the economy was slowing. And the thing is, this time, when you have the slowing of the economy, that creates a negative effect. And people spend less, and they will then, the fewer people will then have to be employed. And you can look at the capacity utilization right now in the US. It's actually down at 77%. Normally, businesses, you'll see that they start to lay off people when it gets down to around 80%. So we also below there. And so things are not developing it's not, it's not a recovery. You're not seeing any kind of recovery. You're just seeing that we are kind of going idle for a little while. We've been going idle for a little while, maybe because of all the stimulus that were supplied back in after the COVID, which for a lot of people have created a lot of buffer in savings. And then you can, see that is starting to now become, not a thing any longer, because people simply spent that money, the surplus savings that they had. So things are developing, and it's just about observing the right things and not be too blind on, if the market tells me I'm fine, I'm fine. Because remember, in 1989, you saw the Nikkei peaking up straight up. Things were absolutely not fine there, I can tell you. And the NASDAQ 2001 peaking right into a top, things were not fine there. So just ask yourself, maybe this time, when we also actually have the largest market capitalization to GDP we have ever seen, do we think, with the slowing economy and the consumer being underwater as they are, and we start to see delinquency rates also moving up quite strongly, do we think that the NASDAQ is telling the truth? Or do we think that maybe NASDAQ is becoming a little exuberant here, or a little frothy? I go with the last.
Gold keeps setting new all-time highs, but price appreciation isn't the only way to profit from owning gold. Monetary Metals is redefining the future of precious metals investing. Instead of paying to store gold, Imagine getting paid to own it. With monetary metals, you can earn up to 4% on your gold, paid in physical gold. That's right, your ounces grow each month, not just your paper balance. A yield on gold, paid in gold, means you're stacking more ounces every single month. And you still benefit if gold's prices rise. You're earning more gold every month and enjoying potential price appreciation at the same time. Go to monetary-metals.com/Julia to learn more and see how you can start earning 4% on your gold, paid in gold. And to that point though, do you stay net long? Since I think last time you and I spoke, we talked about heading toward like a blow off top, like kind of take me inside how you're thinking about it from an investor angle. When will you say, I got to get out of here, or enough's enough? Like, how do you think about, I mean, you see where we're headed, but how do you deal with, because I think a lot of folks probably are like, oh, they don't want to miss out. And that's the psychology of it too. Right. And that's dangerous too. Which is in the book, by the way. So you'll also see about that. Yeah. But that's the thing. I mean, that's the thing. We can all be wrong. I mean, famously also Isaac Newton was long I learned that in your book. Yeah. Yeah, exactly. Right. And he lost a lot of money. Was it Tulip Mania? He got South Sea Bubble. Oh, South Sea Bubble. Yeah. And he actually afterwards said, well, I famously he said that I can calculate the movement of heavenly bodies, but not of madness of men. And he actually forbade anybody that to talk about the South Sea stock at any point when he was present. So he really got hurt by this, and he lost what would have been $3 million in these today's money. So a lot of money, and so it's something where we all get sucked into this because we think, oh, but AI, come on, that's going to help us. Just think about it, the developments and the technologies that we have seen over the years. In the 1920s, we had the car, the radio, electrification, and people tell me that it's a great thing because I can go and pick up my phone and order some things on Amazon. Well, try imagine actually putting, clicking, turning the lights off and on in your living room, or using electrification for your production process, or getting your message spread by the radio, or going into a car, or sitting into a car the first time after having used horses. I mean, we have seen technological developments and advances before, and they have led to a front running of this, which we see again. So I think we are on the cusp of something where technology is going to take us in the next leap into the future here in terms of productivity and so on, but it doesn't save the markets. And I think that's the problem here. We are simply front running these opportunities, and we want to be there. We want to think this is, we are so smart this time. And every time we then just get caught by our own emotion and feeling right of being on the same side as everybody else who says it. And this is that's the mentality that actually brings us to take the wrong. So you ask me about my position. Well, I think I am. First of all, I think we're seeing the late phase of the market development here, because we have seen actually since you and I spoke last time also that the market has been more or less going straight up. So I can't remember when, but we have seen very strong rallies in both the S&P and NASDAQ. Bitcoin, crypto, and so on has been a little more muted, but I think we're about to see the next strong leg there. But I think it's going to be the last in Bitcoin for this time, and I think the next top that is going to be there, which can, by the way, be a lot higher, is going to be a very big top. It's going to be one that, let's see if we get to that point again. So we are seeing the risk taking here, that people get into, and they will probably see the rotation also from crypto, from Bitcoin, Ethereum into small coins and altcoins and memes and so on. And I think on the stock market, you're going to see that there will be a lot of small companies that will do extremely well and outperform the FANG stocks. So I think, based on my model and and this is the second part of my I have the business cycle model, but then there is the Elliott Wave model as well, and there's a liquidity model as well, which are combined my framework. And the Elliott Wave model tells me that we have more upside. We have 7,500 maybe on the S&P, and NASDAQ 28,000, maybe a little extra also there. Should be seen, but it's going to be a very spiky thing, and we are not far off. I looked at the Singaporean index this morning, and the candle for September does not bode well for what is ahead. I don't think it's a top, but I think we are getting closer to a top with what I saw on the Singapore. Now, why is the Singaporean index so important?
because it's a little small economy based on trade, and when that tops, it means that the economy of the world gets into problem, and that's why everybody will see that we have problems. So you want to see the canary in the coal mine, you look to the Singaporean index, and if that tops, then I think the rest is going to have a problem as well.
Interesting. I think you're the first to share that insight on this channel. That's fascinating. Okay, so that's a canary in the coal mine, a bit of a warning sign on the global stage. Then, okay, just a clarifying question too. Like, if you see further upside, it's not like you're short. You're not like shorting though.
No, not at this point. Absolutely not.
Okay.
Not at this point.
Yeah. Because I sometimes see like back and forth on X, and I just want to make sure and get just clarify too. Okay, let me ask you this: the everything bubble. Is there anything that's, well, maybe we should frame up the everything bubble, but is there anything that's not in a bubble?
The problem is with what we have seen over the years is that when central banks are suppressing rates, yields, everything becomes attractive. Why? Because when you are having interest rates at 4% and you come up with this fantastic new idea and you want a business plan tells you can earn 5% on it, it kind of makes sense to do it, because why all the effort if you can just put your money into 4% and getting that on a fixed? So you'll maintain, you probably will do it if it's 5%. But if it's 3%, you would not, because at least why would I go through all the pain and I can see it gives me a 3%? The problem is when we have had these low interest rates that we had for many years, and here I'm not talking about for the last 2 or 3 years here now, but for many years, this is something that is a structure, that a situation that has been built up over what we have done since 2008, is the distortion of capital, of human capital, people, minds, into all sorts of speculative things and projects and so on. So when interest rates are below 1%, back to your project from before, 4%, 3%, well, okay, I'll still do it because it's much better than what I can get in safe returns, and especially if it was negative, when the yields were negative. So the thing is that that has caused a distortion in terms of what we think is good value, is what we can invest in. And that is not something that is going to go away overnight like that. It is something that has built itself into the whole pricing mechanism on the housing market, in private equities companies, what they can, what is a good cash flow from a potential business that you buy into, from everything, bonds, everything. So we have this. It is kind of seeped through the system, and it has kind of put in an understanding what the valuation levels should be. And that's what we see. So the bubble is in a lot of places. If you have to point to places, then the stock market is one thing that is absolutely certain. If you look to crypto market, I mean, there may be some of these will probably be some of these big crypto projects that will be fantastic, but just a crypto for the crypto's sake or for a currency sake, no. And also not the memes and all that. Forget about that. And then you have the private equity companies that have been also buying in everything. Because if you were there, a partner of a private equity company, you're saying, "Oh, I gotta find good yields for my investors." And if you didn't, well, they would pull their money out. So you found something, and that self-enforcing loop has created this situation we're in. So it's been going in everywhere, and we don't feel like we're in a bubble right now, because it's like general. This is how it's been feeling for some years now. So it doesn't feel like that. But you look at the valuation levels; they are extreme, and this is the problem. So when that goes out, when people start to see that you actually have a decline in a lot of assets, it has a deflationary component. That means that people are losing value, they'll be selling, there'll be margin calls, there'll be a lot of things, and that can then start the lawine from, or the avalanche, so it's called the avalanche to roll. And I think we're not there yet, as I said. We're not there yet. I think we can go have a few more months, but we are not as far away from it as a lot of people think. I definitely don't see that.
I have a question. So like, if a lot of people don't see that we're in a bubble, does that make the bubble even more dangerous than if like everyone kind of just recognized it, Yeah,
absolutely. But that's the problem. I mean, it's that the problem that what we don't know and what we don't see, because then we get hit from a blind angle. So people looking at their Bitcoins say, Bitcoin is going to hold up well. Guess what? I don't think it is. I think it's going to be really bad, and you're going probably to lose money on it if you bought in over the last year or so. And there'll be a lot of other things also. The value of your house and so on and so forth. So the bubble is so clear this time. I think that it's unbelievable that it's not all over the news, first of all. It should be something we're saying, guys, we saw these numbers before. We are in something, but of course, nobody likes to be the bearer of bad news, and here I am.
But I also wonder, okay, let's say you're one of those folks, you own some crypto, you own a house, you got some stocks. You might be feeling really good and like prosperous. Like, why would someone want to be like, oh yeah, it's a bubble? They probably feel really good on the way up.
But that's the way.
Yeah.
That's the problem.
Yeah.
That's the problem. And we all know that feeling also, because we all lost money if we've been long enough in the market, that all of a sudden it starts to go against us. And then it's not such a nice feeling any longer. And then we say, oh, why didn't we sell at that point? I actually had one of my friends, he was in Novo Nordisk, which is a great Danish medical company, and they came up with this, what is it called, Wegovy
Ozempic.
Ozempic.
Is that there? I don't know which ones. Sorry, I don't know which. It's Mounjaro. I don't even know the name. It's the GLP-1. Yeah.
Yeah. More people think I'm stupid because I don't know.
No.
But anyway,
I couldn't remember which product was theirs.
Yeah. But the thing is that he said to me, oh, Henrik, you got to understand that this is a fantastic company. I said, yeah, fantastic cash flow. I can see that, but it's very, very highly valued. The valuation is extreme at this point. Yeah, but now we're going into the whole obese thing in the world, and it's the fantastic, massive industry, a massive market. And I say, yes, but that's not it's something everybody knows. So if everybody knows it, everybody's been buying into it already. And guess what? It fell from around 1,200 to around 340 to 300, I think. Within, I think the top was around December last year. So things are that, we will all look at that and they see, wow, feeling good. And he felt so good while it was climbing. And I was wrong, because I said to him by around 900, maybe it's a good time. And then he lost a lot of money on that, unfortunately. And the problem is, I think a lot of people will see the same. They're going to sit there and look at their Bitcoins and say, hey, I've done so well. Fantastic. And and may come down, but then it'll go up again. And then we know if we get hit by the big one, we are feeling sad afterwards and saying, oh, why didn't we? Why didn't I actually, hide out or take a little profit or whatever it is? Because the greed and the FOMO increases as the market is going up. And especially when it goes up as strong as it does right now, it's very, very difficult for the human mind actually and for successful investors to be out of the market and just looking at it and say, hey, I got my share of this. That's Warren Buffett. I mean, he took his money out some time ago, and you can wonder why. And we're looking at these things here now and then say, but he's, I got my fair share of this move here, and I'll be ready for the next move. And that's the problem. So many people are not really thinking and saying, oh, is this a sustainable development? Are there any obstacles in the way? And they're grasping for this and saying, oh, but the Fed has got our back. They will make sure. By the way, the Fed have never been able to do that. And, oh, the AI is going to change the world. Yes, it will, but it's not the same as you cannot have a bubble. And whatever kind of this, argument that comes up. Problem is, the structures are there, and you can see that we are heading into what is a very significant high, as I see it.
All right. Tell us where do you see on the high? Like, where do you see the level? Where do you see it headed? And if it bursts, where do you see it going from there? Have you put targets on there? I don't know if you have.
Yeah, I have. But there are certain things that I probably will not mention Bitcoin, because people will just
they'll go bananas. But this isn't like really a crypto channel, and they're not like the biggest Bitcoin audience. I mean, some people.
Okay, good, fair enough, good. I think the S&P has a rendezvous with 7,500, 7,800 even. I could definitely see that, but it's going to be much quicker than people will understand. I think there is a chance we see that developing really quick. And I think the NASDAQ, as I said, 28,000, maybe higher, even a lot higher actually than that. But there are some Fibonacci levels that are a little more easy to read on this S&P. So 7,500, I think, is around that level. And how low? Well, if you look at it this way, if we have right now the market capitalization to GDP is around 220%. That means if we go back to 2007, where it was 107%, and it was still a bubble, at least in the in the property market, and we saw the NASDAQ and the S&P dropping quite a lot. So if you go to that point, which was still something it could drop from, you would have to half the market's value right now. That means that not instead of having what is it today, I don't know, 6,000.
Where is it today?
I don't know
Yeah.
where we're at.
What are we on? On the S&P?
Yeah.
On the futures, because the market's opening in literally 60 seconds.
Yeah, in 60 seconds.
6,711. Yeah. 6,711.
So if you go down to the half of that, so it means 3,350, around that level, we would still be at the level which would have been the third highest then in terms of market valuation we have ever seen. That's half. That's cutting half of the price. That's 50% down. And so you had in 19. We are just in unprecedented waters here. We have such an extreme market capitalization here, and in extreme, people say, yeah, but the earnings are following. These are forward earnings, guys. And if you look at that, and these forward earnings, they normally disappoint a lot when you start to see the slowdown. So of course, it's a generalization, but that is what you do when you look at indices. And then people say, yeah, but this time is different. And if you start that discussion, then I probably have to go, because I don't think it is.
And that also comes up in your book too, when people start saying this time is different. Let me ask you this. This is another topic as I'm looking at markets. I'm looking at gold. 3,895. Gold has been it's been a really popular topic on this show. It's been on a tear.
Yeah.
If I recall correctly, I think you've also been a little negative on gold, but can I just get your big picture take on gold? And then I have a few more follow-ons.
Sure. So I famously said, or infamously, I don't know, said a long time ago, I think gold is going to decline. And I stand by that. What I did not see was that it would have this extreme rise that we saw first. We didn't, if you looked at miners and you looked at silver and you looked at a lot of things, it actually did not show that gold will have this. So gold was front running things somewhat. And people now say, oh, but that's because we have seen the bull market. I actually stand by what I've said. I was wrong in terms of that it would make this spike. And I think it's actually and people are going to hate me for this, but I'll say it anyway. It's in a kind of a mini bubble right now, because people have been buying into the inflation scenario. And they are also buying into the situation where we potentially have some issues with the monetary system, or a lot of issues actually, which is also what the book is about, the monetary house of cards. So gold should rise long term, no doubt. And my targets for that is $35,000 in 2035 or something. I mean, we can go extreme, really a lot. But the thing is, you are going to see the dollar putting in a very, very large bottom in the not too distant future, as I see it. And if I'm right on that, and I was, again, hands down, I was not trying to explain it away. Did not see gold taking this spike first. Did not. But it does not mean, again, that it cannot take a big decline. Will it reach my levels that I talked about in previous times? No. Could it reach 2,000? Absolutely. And that would still be quite a big drop. So wrong, but I would still argue that it's because simply it's been front running things a little more. And I was not correct on that. But having said that, then I think you're going to see into the final blow-off phase here that Bitcoin and other things are going to outperform gold. And you're going to see that actually the crypto guys will come out again and say, hey, look what we said. Gold is going to be, secondary to Bitcoin. I think you're going to see that into the blow-off top that I'm talking about here, which will not be a too distant event. But come the next few years, you're going to see quite the opposite. And we are starting to see a breakdown between, if you look at SPX and gold, so SPX, or the stock market in gold terms, that we are seeing a crossover and a breakdown of that, which means that gold is starting to outperform on a structural level, on a very secular structural level, the S&P. That doesn't mean that it will be happening in the next few months, but I think on a larger scale, and we're talking the next decade here, I think S&P gold is going to outperform the S&P because it's just fallen so far behind. So I think the big picture is, yes, it's been rising, and everybody is now bullish to gold. I think be careful, because if the dollar puts a bottom in that I think it's going to do, and go right against what people think there, and inflation is not playing out because you actually get deflation. Also, back to my business cycle model, it shows that we have deflationary pressures coming. Well, then you will you don't want to be in gold necessarily. I think people will understand that gold will fulfill its finest task, which will be to provide liquidity when liquidity can't be found. And if the earth is going to open up, as I think it can, with the valuation levels in the stock market and all this, the everything bubble is going to burst, I think you're going to see that the dollar is going to rise a lot. And that will be very painful for gold in the short time frame.
Okay, that's fascinating. Okay, so when this all bursts, the blow off top, the bubble, I'm curious, how do you, because it's a pretty scary scenario, how do you prepare and what do you do in the aftermath? Because do you own gold? Do you want to own gold? Because a lot of people who watch this channel, they do own gold and they've been pretty happy with like the gains, but like, I don't know. How are you?
If you don't, no, but I mean, everybody should own gold, and I own physical gold as well. And but will I buy more right now? I don't think it's.
You're happy if you have it, again, yeah.
But hey, I've said this for a long time, so I've been missing out on that. But luckily, I've been not missing out on other things. So yeah, I'll take that. But just think about it. In a liquidity phase or a liquidity shortage phase like what we saw also in 2008, if a bubble burst, all of a sudden, a lot of people will be forced to go in and restructure their debt. They'll have to make ends meet in terms of payments and so on and so forth. And we are all, the whole world who has a little debt on our balance sheet or personal balance sheet, we all short the dollar sort of, because most of the debt in the world is denominated in dollars. So if that starts to happen, then you will see that the dollar is going to have a positive effect from that. It doesn't mean I think the dollar right now is fantastic, but it's still the cleanest shirt. I mean, there's a lot of shirts out there, and it's still the cleanest one, even though it's quite dirty. So I think you're going to see that it's there. First of all, the restructuring thing of the deflationary bust is going to bring about a massive demand for dollars. And then you're going to see that is actually being enforced and reinforced by the that everybody is practically short the dollar also. So I think with that, if you can stand by that and you say, well, every opportunity where gold is going to decline, I'm going to buy it because my horizon is 5 years from now. Great, then you can buy it, but you may see a very deep decline in this. And it may not even show as much if you look at physical gold, because there can be some, quite different, large differences, as people obviously know. So to the spot price on the markets and the paper gold, and so yeah, you can keep it if you don't need it, if you don't need to do it, but just be aware that that's a situation. And if you got liquidity, well, then I probably will say, well, then stick to your dollars for now. Wait it out. Look at when people are selling gold off in masses, and then thinking maybe of buying something there. When people start to say, oh, gold is losing its shine or whatever, that's probably the moment. So I can't tell people to keep it or not. Everybody should have some gold in their portfolios, but I think it is a matter of the shortage in dollars that is going to be into this phase, which I think a lot of people have a difficulty in actually imagining.
Mm-hmm. So to kind of recap, so with your thesis, with the everything bubble collapse, that initially is going to cause deflation, and that will clean out a lot of the bad debt too. But then, as part of your thesis, and correct me if I'm wrong, then we move into after the deflationary bust, you move back into like high inflation environment, like a stagflationary environment. Is that correct?
Yeah, because everybody will say when I say, but Henrik, the Fed is not going to allow that there's going to be a deflation, or Trump is not going to allow it. Then I'll say, first of all, there's never been a central banker in history or president in history who would allow it if they could disallow it. So like that, they cannot. So let's first agree on that. Secondly, of course, they're going to come out with guns blazing. And the problem is this time around that, back in 2008, the situation was quite different. You had a deflationary environment. You had globalization going full speed, which means that there was a pressure on prices. And you also had a lot, just of things in productivity development and so on. So things were actually being developed cheaper. And you saw that the deflationary pressure was just, to the downside. The Fed was fighting with that. Now we have reintroduced inflation. So in 2020, when COVID hit, the Fed went out there, everything in. And at a time where you had people going home, couldn't go to work, you actually had a disruption in supply chains, in the supply chain, aggregated global supply chain, you can kind of imagine. When you then put demand into that, a lot of demand into that, we got an extra, I don't know, bonus check from the government. Also, it was some savings that they had, and they just poured it back to people. And we spent the time home. People started to spend that into a supply chain, which is disruption. If you on the first year of economics and at university, you learn about supply and demand, and if supply is collapsing and you put a lot of demand into it, what you get is inflation, and that's what we saw. That inflation is now going through and has now ripped through the society and caused yields to rise, have caused prices to come up a lot. Remember, this is a stock and flow thing. There's a difference between how much water there is in the water top and how much water is being poured in every month and every minute. And the thing is, inflation is the water being poured in, whereas the price level is what is in the top already. And this is the problem. The water has gone up. And people feel that like inflation, but it's the price level that has been going up. And that is what is hurting also the consumer. So the problem is now the Fed is going to come out again and say, oh, we can look at disinflation, because you can actually see that the amount of water coming out can decrease, and it looks like there's going to be no water coming in. And they don't like that, the Fed. They actually like a steady flow of 2% inflation. But the problem is, if they do that this time and come out and introducing a lot of money into the system again, or doing QE or whatever they're going to do, the problem is people will then start to say, oh, look at this, we're going to get inflation. And then the expectation of inflation is going to come up. And this is not just something I say, this is not just a thesis, this is actually what you can observe if you look at yields. And there is a significant move higher in the yields now, which have shown that we have put in as I see it, a secular bottom in yields. We have put in a secular bottom in commodities as well. It may come down, and we may see it as disinflation or outright deflation. But I think the problem is that when the Fed tries to do what it did in 2008, which they will, or 2020, then they're going to see inflation. And that's the problem, Julia, because think about it. Our parents or grandparents, if you ask them and say, guys, you know what? Today we got this modern monetary theory. It's incredible. Every time there's a problem, you just pour money on it. Why didn't you think of that in the 60s or the 70s when you had when you had slowdowns? And they'll like, oh God, they'll say, you know what we got? We got inflation at that point. So this is the problem, that the shift in the economic climate, in the regime that I call inflationary regime, and the inflationary regime has shifted. It's so clear. That's also why Jeff Goundlach talks about that. It has shifted. Doesn't mean inflation is going straight up. It means that the development over the next many years, just like after Volcker killed inflation in 1981 or 79 to 1981, which is also in my book, you'll see that there is a development to the downside for a secular long time, like what you had from the 1920s into the top also, and so on. It's going like that over the last many years. We have a significant bottom in inflation. It's been moving up, it's coming down, but the trajectory now is higher. And if the Fed comes out like they did in 2008 and 2020, they're going to create inflation, like what our parents would have told us if we just said you just pour money on it. And that is the problem. And this is what none of us has really. I'm 50. I was 6 years old when we saw this regime shifting last time. Not many of us can understand and see this. That's why we have to ask the people that are a little older than us and try to understand what is going to happen to inflation in an environment where the economy just rolls over and you try to pour money on it. And if you do that, then you get inflation. And if the economy doesn't turn with that, because that's what they hope that when they cut the rates, you got to interrupt me if you want to say something.
No, I want to listen. No, I don't want to interrupt. Okay. Keep going.
So if they are coming out again and say like what they did here now in September and probably going to do here in October also, cut rates, they want to have Mrs. Johnson in the US to say, oh, I now saved $100 on my mortgage loan. Fantastic. I'm going to take that money immediately. I'm going to go out and I'm going to spend it immediately, all 100. And preferably they want her in, figuratively speaking or, rhetorically speaking here, that they take this money and that she actually doubles it by taking up a credit loan or something, and then spend that money as well. Because if she does that, then you have the positive cycle that they hope to will start going on, which will then create higher growth and so on. The problem is, Mrs. Johnson have seen inflation this time. And probably also her debt levels is a little higher. If you look at an aggregated level, you can see the US, you had 60% into GDP last time. We're now at 120%. So the problem is, if you save those $100, you kind of look at it and say, would I now go spend it, which is what Powell wants me to do? Or will I actually stuff it and just see if there's going to be a rainy day in the next coming months here? If you do the latter, which would be normally from a psychological perspective from human beings, I mean, she just saw her neighbor getting laid off and prices have risen, as we talked about. Wouldn't it be natural for her to think, no, I've got to save this? And I think that is the thing which is going to play in this time. This is the financial world completely ignorant about, as I see it. They think that the Fed, every time they print money, it's going to create a fantastic effect in the market. But guess what? If it does what I'm saying there, you can probably see that money maybe setting into commodities, which I think it will, but potentially not supporting the purchasing power, the power of the consumer, or the wealth of the consumer, because they're going to save it instead. And that is the problem. If she saves that money, it's not going to work. So you may introduce then inflation, because some of the money will start in the financial world and people start to speculate with that, and you'll not see the real economy picking up. And that is stagflation. That's what you see. That is why the slowing of the recovery, if they come out like that again, and the money does not support the consumer because he doesn't want to spend it, then you have a problem. And that is what I think we're going to see.
Wait, a quick question though. If the consumer doesn't spend it, does that doesn't drive more inflation, right? I thought if you were buying more, chasing.
Correct.
Okay. So
correct, but there are different types of inflation also.
Okay.
So you can also have, so this is that would not be consumer inflation. So correct, it's actually very spot on. You need to see her actually spend that, and it will start to turn faster. But the thing is, it can also happen in other part of so it can happen also just due to speculation, also with the money in the financial system starts to get into commodities, for instance, because that money will need to find a place, right? It needs to, there's so much money building up. So where will we then put it? And if the economy demand doesn't pick up, well, then it can see it actually start moving into things like gold, silver, commodities, and so on. And that's why I think, speculatively here, but I think you're going to see a different kind of dynamics to what is going to happen when the Fed comes out, because the Fed is going to come out like in a massive way.
I guess like for the Fed, like we've talked about, and your book obviously talks about like the error of the massive policy errors that they've made. How much does the Fed, how much can they even make a difference at this point? Like, I think the last time you and I spoke, correct me if I'm wrong, you made the case that they should be cutting, or should have already been cutting. Will their cuts even make much of a difference at this point? We just saw the 25 basis point cuts. Just would love to get more of your take on the Fed, and I take it they can't really correct their errors at this point. Maybe they're too late.
But they are way too late. And again, it's down. I mean, it's the division between the real economy, you and me having a job and having a home with a mortgage loan, and then the financial world, where it's all about, if liquidity comes in and that money, then you can then Nvidia will be worth this much, and so on and so forth. This is the financial speculation world, and this is the schism that we're starting to see. The most famously, I put up a few charts also where you can see the development in the S&P, and it actually follows the job openings that you very, very clearly over the last 25 years. And now you just see a big divergence between that S&P going up and job openings going down. So this is the problem right now, right here, is that you have this disconnect going on. And so what the Fed is doing now is like rearranging the deck chairs on Titanic. So, shuffling them a little around and making people feel more comfortable.
Maybe helping the first class passengers, the asset holders.
Helping the first class passengers, definitely. Yeah, because, it's not going to help a lot for Mrs. Johnson here right now. I can promise you, since the cut here 14 days ago, she doesn't feel much of a difference. So the problem is, and as I said, probably also last time, I saw the last survey on how difficult people find it to put food on the table in the US. It seems like 16% of the US population find it very difficult actually to put enough food on the table. That's the real world. Mm-hmm. That is the real world. And this is what people tend to not to understand, honestly.
Yeah, like kitchen table, dining room table, economics, like in the household, like how people actually feel. And then I'm saying this is a millennial, like I'm a 37-year-old, and like home prices these days, if you want to go buy your first time home, it's crazy. And a lot of this stuff's not really moving right now. And so I'm trying to be patient, but yeah, it's just, I think I saw a stat and I'm probably wrong. Someone said, I think the average age of a first time home buyer right now in the US is like 56 or something crazy like that. It should be, someone in their 30s, which is just wild.
But that's the problem. The problem is, again, and you asked me where we have a bubble as well. If you look at the price, the Schiller price index also on homes, it clearly shows that there is a bubble in housing prices as well. And especially if you look to the affordability, which you talk about right now, and the affordability is actually now at the levels we were in what we at least here in Denmark call the poor 80s, where people did not have enough money. So that the whole stock market is booming, and all this is simply the division between the real economy and the financial world. And this is where I call the financial world and the liquidity test, because they kind of think it's all about liquidity. By the end of the day, it's not. It's about the 70%, the bottom 70% of US population, but of the world population. How well are they? What do they feel like? And if you follow that, you can actually see there's a very close relationship between the consumer confidence and the unemployment rate. The unemployment rate just follows. If you invert that, you'll just see how that actually, when the consumer confidence plunges, it takes a little while, and then you start to see the unemployment rate going up, which is down if you invert it. So I think that is the situation right now. We are in this twilight zone where you don't really understand what you need to look to the financial world, which we also talked about earlier, the prices, the stock prices. Henrik, what is it that you don't get? Is it because you're out of the market? I can tell you, I'm bullish, and I'm so long, and it's actually irresponsibly long. I would say, call it almost, in terms of what I should do at this point. But I can just see the structure developing as to a blow off top, and then the real world. The real world is not feeling that, absolutely not. And that schism is going to be, and that's also why, back to the book, because this whole setup that has now been created, this monster that we have created, where valuation levels are so high, and the only way we have out of this is inflation to come in and try to make things and ease things up or normalize things. That is going to be hurtful to the consumer, the ones that are actually already looking at it and say, hey, and if they're going to lose their jobs, and if your unemployment rate unfortunately goes up, and you at the same time later down the road could see more inflation, and especially with the price level that we have back to the bathtub, well, a lot of people are not going to be very content. And I think that is actually the monster that the central banks have created, which is why I thought this book here was really needed, because somebody needs to say, this is not about Trump. I'm not necessarily a fan of Trump. I'm not necessarily a fan of any president. I don't care. But this is not on Trump that you have created these kind of valuation levels. This is on the central banks. Mm-hmm. This is on the hubris of the central banks, believing that they are able, through Keynesian economics, to micromanage inflation levels from, no, we don't like 2.3, so we want it to 2.2 or 2.0. I mean, the ignorance or the hubris of this is just staggering. And I think we're going to see that over the next few years here when it bursts, and we're going to see inflation coming out later, that it's unfortunately going to be the not so well off people that is going to take the biggest blow because of this. And people will blame it on Trump.
Mm-hmm. Yeah, because, and in your book, as you point out, like this house of cards, this goes back to post 2008, from like just the central banks, from the ultra low, near zero rates for over a decade, quantitative easing, like the printing of trillions in central bank money. That's led to like massive debt accumulation, whether it's government, corporate, or household. Then we've seen the asset price inflation, leverage and speculation, and just like this kind of faith that people have in central banks that's dangerous, that they'll always come to the rescue. And
I call it the rise of the demigods, and you kind of have that. I mean, I can't remember having sit and been watching, the Greenspan, presser back in the days, but today it's like everybody is just on these FOMCs here. We kind of think that they have a magic ball, and we've just seen again and again and again they miss on terms of where we're heading. They thought we had a strong economy until the other day. They didn't see the 9.2 or 9.1 inflation spike into 22.
Transitory.
They didn't see the transitory and all that. I mean, how much do we need to see before we actually take this belief in them and kind of say, well, maybe they don't have this kind of crystal ball that we all think, and maybe they can actually be, the more they have been doing, and the whole thing. I mean, that's also what I say in my book, that reinventing money printing, and then you award that with a Nobel Prize in economics. I just cannot understand it, and I hope the next few years is going to prove that that was a mistake.
I asked you this last time. I think I asked you this. If you could be inside one of those FOMC pressers, maybe as a journalist, or maybe if you could have time to sit down with, let's say, Fed Chair Powell, who's the chair right now, what would you want them, what would you ask them, or what would you want them to understand?
The real economy. I would like to, if we had to investigate to reform the Fed, which I hope definitely, not just the Fed, but central banks all over, to sit down and say, guys, what are you looking at? What are your leading indicators? And which one are you looking at? I mean, you just have to go into the charts and take a look at, what I said before, look at when the unemployment rate and when the consumer confidence starts to develop. What are you looking at? Which are leading indicators? Because if you look at inflation, then you're looking at a lagging indicator. You don't need to know a lot about economics to understand that the inflation level that you have out here is actually, the process of a lot of different things that have been bought and purchased into various depots and intermediaries and so on before you get to that level. And it can take a long time, because first you start to use whatever you had in your storage, and then you'll buy some more, which then goes up in price, and that takes some time. So if you look at something that is a lagging indicator, say, hey, I got to drive this economy now by looking out the rear window. That's what they do. So if that's, I hope that's not the case. But if it is, I'm terrified about what they can. That we're seeing the consequences of that, because they're hopelessly late in rising rates and they're hopelessly late in cutting rates. And this time is even worse, because they kind of feel guilty that they brought this inflation out, and now they're going to hammer inflation. But in that process, they're hammering the consumer. That's why I said, they need to cut. They need to cut the short-term rates, because that will have an impact. And no, inflation is not a problem, because right now the consumer is not well off. If the consumer is feeling great, as you said before, then you can have price inflation. People start spending a lot of money. But if 15.6% of the U.S. economy, or the U.S. population, not the economy, but the population is finding it difficult to just put food on the table because of housing, because of rates, because of mortgage loans and what have you, car loans and so on, then you need to make sure that they're, give them a little, give them the ability to breathe here. And that is the problem. And that's where I think it's too academic. It's too much from the financial world. I think this should be about observing leading indicators on the consumer, understanding that 70% of the US economy is the consumer. And of that, you'll have to look into, what people spend. And people will spend up to a certain income level. They will spend everything they have. And then you'll start to save. But if you focus on the ones that save 99% of their income, well, then you're probably not hitting things right. You're simply looking at the wrong thing. So when there was a journalist saying, hey, what is it that the consumers do not understand? There was 3 or 4 FOMCs ago. Since they are so, apparently not happy, the confidence is so low. And Powell's like, yeah, something tariffs and blah, blah, blah. That's probably where I would start. Start to understand it's about the consumer. Mm-hmm. It's not about the economy from a financial perspective, about crypto, about all these things. It's about understanding the basic Mrs. Johnson's economy. And if she's feeling good, then things are better. I would like to see what they do there. And that was what I would be asking more of. And there was a good journalist, I can't remember who it was, but it was a fantastic question.
Yeah. Henrik, I've so enjoyed having you back on the show. Before I let you go, let folks know how they can, find more of your work, support your work, pick up your book that just came out. I got my copy yesterday. Anything that you'd like to leave this audience to think about, any parting thoughts, the floor is all yours.
Well, at Henrik Zeberg would be the place on X. I also have a Substack channel that you can also find me on, also at Henrik Zeberg, I think. And what to leave you off with? I think when everybody is as I said earlier, not just today, but also back, half a month, 6 months ago, when everybody is starting to say, "Oh, this is great, and there's no stopping this train," that's when I start to be worried. We were not there a month ago. I'm not saying we're there right now, but we are seeing increasingly that people are expecting this can just go on, and they're now all the things are now starting. Maybe we can even get something of a peace also in the Middle East. I hope for that. But if we can, these things will add on to it. So be careful. I just want to say that, because when it feels the best, like we talked about with the Nikkei and the NASDAQ and all that, may not be the time for you to put your money into exactly that. There may be that you actually reach the peak, euphoria. So when you feel the best about your economy, think about it and say, okay, maybe this is too good right now, and maybe there will be some downside. So take good care, and then study what real people, how they feel, not just what the financial market says.
Henrik Zeberg, head macroeconomist at SwissBlock and author of The Monetary House of Cards, the bust of the everything bubble caused by central bank hubris. So wonderful. Welcome you back to the show. We are looking forward to our quarterly appearances. We will have Henrik on the first Wednesday of every quarter going forward. Really thrilled to have you on more often. Really appreciate you helping us all learn and get better and just sharing all of your knowledge and your wisdom. Thank you so much, Henrik.
Thank you, Julia.